Welcome back to Bloomberg TV Canada's special presentation of Industry Insiders. We continue our conversations with the chief executives of Canada's Big Five banks. Royal Bank of Canada has been the country's top financial institution for most of the last century. With $1.2 trillion in total assets, it's also the fifth largest bank in North America. RBC acquired Los Angeles-based lender City National last year and has been on the hunt for more U.S. acquisitions. CEO Dave McKay sat down with Bloomberg's Danielle Bochove to explain why.
So we closed the acquisition of City National Bank in November 2015. So we just completed our first fiscal year with City National. We're extremely pleased with the momentum and the progress of City National through 16 and now into 2017 as we kick off a new fiscal year. So to build on that momentum, we think about geographic expansion of City National into more sites in New York City, into Washington, into other parts of the United States. So you'll see geographic expansions organically. We're looking at putting more product out there for our existing customer base in Minneapolis and our wealth franchise across the United States. So the strategy is one of geographic expansion and one of product line expansion and cross-sell into existing wealth customers. With that comes the opportunity to look at very selective inorganic opportunities, small tuck-in acquisitions where it gives us a geographic footprint in a new market, such as Washington or Houston or some other markets, or it gives us a different type of client base, a wealth client base that we can cross-sell other products into. So that really is tuck-in acquisitions that span the U.S. market and present an opportunity to create value for our shareholders and for our existing customers.
You guys wound down your U.S. proprietary trading business to comply with Dodd-Frank. Now, of course, the talk is that this is all going to be rolled back, or certainly parts of it could be rolled back under U.S. President Donald Trump. How do you feel about seeing that regulatory environment presumably loosened again, and what would it mean for the bank?
No, certainly regulation with a certain outcome was designed around Dodd-Frank, and we're certainly compliant with Dodd-Frank. And as you just referenced, we changed our prop trading practices and disbanded those businesses across the United States. Some of it was moved offshore into other markets, such as Bahamas, and now we've shut those down for the most part at the same time, and that there's not economic activity for us. So as we think about regulatory change going forward, it's difficult to anticipate. So I think we're at a point where it's a wait and see to see what type of policy change, regulatory policy change, and general policy change around the economy comes out of the new administration. And it's difficult to sit here today and anticipate what may come, and I think we're more in a reactive mode to see what makes its way into policy, and we'll adjust accordingly.
I guess net, though, you must have a sense of less regulation in the United States. Would that be good for your existing footprint or not?
Absolutely. There is a cost of regulation in all our markets, whether it's in the institutional corporate market and capital markets, whether it's in the high net worth and commercial market in City National. There is a cost of regulation. It makes it more difficult to do business with clients, and a regulatory environment that protects the core intent of regulation to maintain a sound financial system, which is important, but where we can ease back in some of those regulations to ease business, I think would be welcome, and would be welcome in all markets, not just the United States, but certainly would be. But we're in a reaction mode to see how that may transpire and what may come of it.
I want to talk to you a little bit about the consumer debt situation in Canada. Royal Bank set aside the most money for soured loans in 2016, I think since 2009. In the fourth quarter, you mentioned higher provisions in Canadian consumer portfolios, more impairments in credit cards as well. How serious, in your eyes, is the mounting consumer debt situation in Canada?
Yeah, our increased credit provisions in fiscal 2016 came from two sources. One, we had higher wholesale write-offs at the beginning of the year, and those tapered off over the year, all of it in the energy portfolio, largely in North America. Towards the latter part of the year, you started to see credit provisions start to increase in the retail portfolio, again concentrated in those oil-affected provinces, particularly in Alberta and Saskatchewan. So you saw credit card portfolios, auto lending portfolios, for the most part, start to show some signs of stress, albeit moderate stress at this point. So I think really the Credit portfolio is very strong. In fact, I think we saw stronger credit performance outside of those oil-based regions year over year than we had previously. So, all the evidence right now points to a very strong Canadian consumer. We see job creation, the most recent numbers, albeit some part-time job creation. We have a very strong economy. We've got strong credit portfolios. So we're in a base of strength. So I think the rules that we've seen on the mortgage side are certainly very helpful in managing the growth in mortgage credit over the coming couple of years. And I think we welcome those regulations to slow down house price growth and mortgage growth to make sure we maintain a very stable and sound banking system going forward.
And obviously the finance department has been reviewing the options to share the risk with lenders.
Yep.
Two scenarios that have been kind of highlighted, which would be the first loss or the fee-based. Of those, which do you prefer?
I don't say I can comment on which I prefer. I think there's a lot of information you need about both approaches and how they're structured before you can just say which you prefer. What I will say is I think we've had a very sound mortgage industry in Canada over many, many business cycles, and it's performed exceptionally well. It's a user-paced system that I think also is very fair. And therefore, we have a sound system. So how we tweak that to share the risk, I think there's a number of options, but it would be really premature for me to communicate or just choose between two systems that haven't been well defined yet. And I think we're in that process now of going through what do you mean by first loss and how is it constructed? What do you mean by loss sharing at the back end? Really too early to tell because I don't know how they're defined very clearly yet.
It's interesting to see you talking about the stability of the system. You have other comments that paint a very different picture, right? The head of the CMHC, for example, quite recently saying that he's more worried about mortgages, more worried about debt than ever before, painting a picture almost of the potential for a housing crash. What are your thoughts when you hear things like that?
Well, we think about the strength and stability of the housing market in Canada. We look at a number of factors, both on the supply side and on the demand side. And we would say the Canadian market has kind of three different factors to it. You've got the Vancouver and Toronto housing markets, which exhibit their own characteristics. You've got the oil-affected regions, then you've got the rest of the country. When you look at Toronto and Vancouver, you certainly see very strong demand creation. You've got supply creation, demand creation, but supply and demand are out of balance. And demand far exceeds supply. So in the context of low interest rates, strong demand, strong household formation, strong immigration creating that demand, low supply of single-family homes, not enough land being released into the supply and creation of new single-family homes, you're getting significant price appreciation. You're seeing a bit of the opposite in the oil-affected regions where demand has come down, obviously, supply has been managed well, and you're seeing relative price stability, albeit resales are down. And in the rest of the country, you're seeing a relatively balanced marketplace. So those are the key factors that we continue to look at. What creates demand in a marketplace? What's the supply management side? As long as the two remain somewhat in balance, you're going to see a fairly stable marketplace. And again, the key driver of the mortgage industry, the stability of mortgage credit in Canada is unemployment and cash flow. And you're seeing very strong employment numbers in the country.
Well, although arguably in the latest report, you could say that the unemployment rate was falling because the participation rate was lower, right? I mean, there are people who are dropping out of the workforce.
You see that in every survey, albeit a 6.8% number is still a relatively strong number, and you're seeing how Canadians are servicing their debt in an acceptable way across the country in almost all portfolios.
That was RBC CEO Dave McKay. Still ahead, Canada's second largest bank, Toronto Dominion, is aiming to dethrone RBC. TD's Bharat Masrani is up next.